A perfect storm is brewing for what just a few weeks ago was the most anticipated stock market debut in history. While most investors were mesmerized by the incredible story of SpaceX, they're now facing a brutal reality. The stock, trading under the ticker SpaceX, has lost nearly half its value since its peak on June 16th, just days after its record-breaking IPO. But I'm here to tell you, the worst is yet to come. This isn't just a post-IPO dip. This is the beginning of a potential collapse. 4 critical red flags are all about to flash at once. A perfect storm of negative catalysts is gathering, and it's set to hit in a matter of days. In the next few minutes, I'm going to break down the unprecedented lockup expiry, the first high-stakes earnings report, and why a massive crash in SpaceX stock could happen before you even have time to react. It all starts with a detail that the mainstream market is completely overlooking. Now, before we get into the data, let's be absolutely clear. SpaceX is a phenomenal company. What Elon Musk and Gwynne Shotwell have built is nothing short of revolutionary. We're talking about the first private company to send a liquid-fueled rocket to orbit, the first to deliver cargo to the International Space Station, and the first to master the landing and reuse of an orbital-class booster. The list of groundbreaking achievements is staggering. The business fundamentals on the surface look incredible. Starlink has blown past 10 million subscribers. The Falcon 9 rocket launched 165 times in 2025 alone, more than every other launch provider on Earth combined. The vision to make humanity multiplanetary is inspiring, and the ambition is off the charts. I've been a huge admirer of SpaceX for years. But as investors, we have to learn a critical lesson, often the hard way. The company is not the stock. A brilliant company can have a terrible stock, and a beloved story can be a disastrous investment. And right now, the story of SpaceX is colliding with the harsh laws of market physics. The problem isn't the company's long-term vision, it's the stock's immediate reality. The post-IPO enthusiasm has evaporated, the initial pop has turned into a painful drop, and what's coming next could be even worse. The storm makes landfall this Tuesday, August 4th. After the market closes, SpaceX is set to release its first ever quarterly earnings report as a public company. This is the moment of truth. This is the first real valuation test, where the Wall Street hype machine meets the cold, hard numbers of a financial statement. Remember, the S1 prospectus that came out before the IPO already delivered a massive shock. It revealed a staggering net loss of $4.9 billion for 2025. That was a number far outside what even the most bearish analysts, relying on leaks, had assumed. The market brushed it off in the initial IPO frenzy, but now that frenzy is gone. The stock is broken, trading well below its $135 IPO price, and investors are scared. Now, all eyes are on this first report. The consensus on Wall Street is that SpaceX will report a loss of around $0.22 per share on revenue of roughly $6.8 billion. The pressure to meet or beat these numbers is immense, but it's not just about the headline numbers. Analysts and institutional investors will be dissecting every single metric. What is Starlink's average revenue per user, or ARPU? The prospectus already showed ARPU sliding from $81 down toward the mid-60s as SpaceX pushed into lower-priced international markets to add subscribers faster. That's a defensible growth strategy, not automatically a red flag, but it means the market needs subscriber growth to keep outrunning that price delusion quarter after quarter, and any sign that the trade-off is tipping the wrong way will be punished hard. How much cash is the newly acquired AI division burning through? Any sign of uncontrolled spending will be punished. The options market is already telling you everything you need to know. Traders are bracing for impact, with implied volatility soaring. Contracts expiring this week are pricing in a massive swing in the stock price, up or down immediately following the report. This is a binary event. There is no room for error. A flawless report might give the stock a temporary reprieve, but any miss on revenue, on subscriber growth, on guidance could send the stock spiraling. And that's just the opening act. If you're getting value from this breakdown and want to stay ahead of major market-moving events like this, take a second to hit the like button. It tells YouTube that this kind of deep dive analysis is important, and it helps more investors see what's really going on behind the headlines. The earnings report is just the fuse. The bomb itself is set to go off just 2 trading days later. On Thursday, August 6th, the first major IPO lockup expires, and the scale of this is something the market has never seen before. For those who don't know, a lockup period is a contractual restriction that prevents insiders, like employees, early investors, and venture capitalists, from selling their shares for a certain period after an IPO. The goal is to prevent a flood of selling that could crash the stock, but that period is about to end. And we are not talking about a trickle of new shares. We are talking about a tsunami. On August 6th, a staggering 911.5 million shares will become eligible for sale for the first time, worth well over $100 billion at recent prices. Let me put that number in perspective. That is a wall of supply held by people who have been waiting years, some over a decade, to finally cash in on their paper fortunes. These are people who got in at valuations that are a tiny fraction of today's price. For them, even at these depressed levels, selling is pure profit. Historically, stocks facing large lockup expiries see significant downward pressure in the weeks that follow. But for SpaceX, the situation is far more dangerous. The stock is already what Wall Street calls a broken IPO. It has failed to hold its initial offer price. Investor sentiment is already in the gutter. Now you're about to introduce a supply shock of historic proportions into a market with almost no demand. Morningstar has already put out a warning, noting that billions of shares could hit the market over time from these staggered lockups, creating a prolonged overhang that could weigh on the share price for a very, very long time. It's a simple, brutal equation. A massive increase in supply plus weak or falling demand equals a lower stock price. On top of these immense financial pressures, the operational realities of running a rocket company are starting to hit the stock price in a way they never did when SpaceX was private. In the private markets, a failed launch test is just part of research and development. It's rapid, unscheduled disassembly, a learning experience. But in the public markets, it's a terrifying headline that spooks investors and sends automated trading algorithms into a selling frenzy. We already got a taste of this in mid-July. A Starship test flight was aborted on the pad due to an engine ignition failure. The stock slid for several straight sessions on that news, briefly falling more than 5% in a single day and dropping below its IPO price for the first time. This creates an incredibly dangerous feedback loop. Every single launch, every test flight, every static fire is no longer just a technical milestone for the company. It's a high-stakes binary event for the stock. Imagine another setback, another aborted test, or worse, another failure in the days following a potentially weak earnings report. With the entire financial world now watching SpaceX's every move, a technical issue could reinforce a broader toxic narrative of execution risk. It could be the final straw that causes skittish retail investors who bought into the hype to run for the exits en masse. The very thing that makes SpaceX so exciting, its willingness to push the boundaries and risk failure, has now become a massive liability for its stock price. And finally, if you look just beyond this immediate perfect storm, you see the fourth catalyst that's already playing out, the constant nagging burden of debt-fueled dilution risk. SpaceX's ambitions are colossally expensive. Building a city on Mars, deploying tens of thousands more Starlink satellites, and creating space-based AI data centers will require hundreds of billions of dollars. To fund this, the company needs cash, a lot of it. The company's own S1 prospectus basically spelled it out, signaling that it will continue to use both debt and equity financing to expand. For public shareholders, that's a red flag. Equity financing is just a corporate way of saying selling more stock. Each new share they sell dilutes the ownership stake of existing shareholders. And this isn't a distant hypothetical threat. It's happened once already, and it's a preview of what's coming. Less than 2 weeks after the IPO, SpaceX went to the bond market with a $20 billion offering to refinance the bridge loan behind its XAI acquisition.
Demand was so strong, almost $90 billion in orders, that the company upsized the deal to $25 billion. That's $25 billion of fresh debt added to the balance sheet in a matter of days, on top of the $29 billion SpaceX already carried at the time of its IPO. It tells you exactly how much capital this company is still going to need, and it's a strong signal that more debt and eventually more equity is coming. It puts a long-term overhang on the stock, making it very difficult for it to find a sustainable bottom even after a crash. Every dollar of profit the company might eventually make will be spread across a wider and wider base of shares, suppressing the stock's potential value for years to come. Individually, any one of these catalysts would be a major headwind for a stock: a high-pressure earnings report, a massive lockup expiry, a sensitivity to operational headlines, a debt load that's already ballooning.
But what makes the situation at SpaceX so uniquely dangerous right now is that all four are converging at the exact same time. We have a high-stakes earnings report that could easily disappoint hitting on Tuesday. We have a 900 million share supply bomb dropping just 2 days later. We have a stock that is on a hair trigger, reacting violently to any news of operational setbacks, and we have a company that just proved with a $25 billion bond sale exactly how much capital it's going to keep needing. This is the perfect storm I warned you about at the beginning. It's a catalyst stack that appears almost perfectly designed to crush a stock's momentum, absorb all its liquidity, and reset its valuation to a much, much lower level. So what am I doing? I'm staying on the sidelines. The laws of supply and demand are universal, and a flood of supply is about to hit a stock with broken demand. This isn't a bet against the company's ability to eventually get to Mars. It's a calculated decision based on the data that suggests your investment portfolio might not survive the journey in the short term. The big question is, can SpaceX defy the laws of market gravity, or are these catalysts simply too powerful to overcome? Let me know what you think in the comments below. And if you got value from this in-depth analysis, please hit that subscribe button and turn on notifications. In a market this volatile, you need to stay ahead of the narrative, and that's what we do here every single week. Thanks for watching.